Good evening, everyone. So we welcome you to the second session of 3D Marathon. This is Nitish Kanan, a CA final student, will be hosting throughout the session. I'd like to extend a warm welcome to Jay Singh, sir. Sir, I'd like you to drive the session.
Yes, so very good evening, friends.
Sir, just a minute, sorry for the interruption. Students who missed the first session can watch it over the SIRC YouTube channel. It's available now, right now. You can make use of it. The continuation of the session will be streaming now. You can make use of it. Thank you. Sir, the stage is yours.
Thank you. Thank you, Nitish, for the information. So, students, now I hope that all of you are there in this case. We will thereafter, students, we will thereafter, students, there is a noise.
Nitish, can you mute yourself? Other than sir, everyone can mute. Yes. Yes, sir. We can continue now. Yes, sir.
Yeah. So, students, continuing, students, then the first class, what we have discussed was in respect of the non-resident taxation and transfer pricing. One particular case study of that is left, and that is what, students, the first and foremost, students, I'm going to do it. This is a ICAI in its latest RTP as well as in the MTP, both have seen the coverage, students. This is actually based on an amendment through a notification. Not many of you are actually aware of that, what this amendment or the notification is all about. So therefore, a bit of clarity is required about understanding that particular amendment and that notification, students. I'll let you know. First of all, let me tell you which is the question which I'm referring in this context. One of the very important questions, students. Amrita, Akash, praising, Charita, good evening to all of you, students. So the amendment here in this notification was introduced. In fact, frankly speaking, kudos to ICAI, the way they have drafted a question on that. Just imagine the kind of the level in which they are into it. This is page number 79, students, which is there, page number 79, and that is question number 36. Question number 36, students. So therefore, let's have a look in this context. So in this context, students, if I have to let you know about this particular part, students, what exactly this concept is all about, first all of you have to first understand, and then I'll take you through towards this particular question, case study, and thereafter its solution. So here is a case of the MFN status, the most favored nation clause. Have you heard of this one, students? The most favored nation clause. So this is, students, a kind of an OECD model, students. This is a kind of, students, the OECD model which has been there, which is to be considered over here. And that is what, students, the point is. Now let's look upon to what exactly this concept is. Supposingly, I'm just giving a hypothetical example so that you all are understanding this concept thoroughly. Supposingly, students, there are two treaties which are being entered. Say the first one was, for example, I'm just giving an example, India-Singapore. That is the first particular treaty. And thereafter, say, for example, a first treaty is, say, India-UK. And second one, students, is, say, India-Singapore. Now, both UK, Singapore, and India, I'm just giving a hypothetical example. They are the members of OECD. Now, generally, students, all the double taxation avoidance agreement treaties, they are entered either on the basis of the OECD model of the convention or on the basis of the UN model of the convention. So we have got two model of convention, either it is OECD model of convention or the second one, as I told you, UN model of convention. So this is required in the case where when the countries are the member of the OECD, that is point number one. And thereafter, students, just take this case study which I'm discussing with all of you right now. So first was the UK treaty which got entered. The second treaty which got entered was the India-Singapore treaty. Now, India-UK, say for example, in respect of the royalty and FTS income, royalty and the FTS income, they are talking about a tax rate of say 20%. Royalty and FTS income, they are talking about a tax rate of 20%. Whereas, so far as India-Singapore treaty, which came later on, because now the era is that the rates of taxes are coming down. So therefore, while entering into the treaty between India and Singapore, they have given a new rate of tax in respect of royalty and FTS, and which was, say, for example, 15%. So India-UK treaty, old DTAA treaty, which was at the rate of 20%. Subsequently, India-Singapore treaty, the new treaty, having the contemporary rate of 10%. Having the contemporary rate of students 10%. Now, as I told you, students, all the countries are the members of OECD. That is point number one. And India has given the MFN status. MFN means the most favored nation status to UK. At the same time, India has also given the MFN status, students, the MFN status to Singapore. The MFN status also to the Singapore. So therefore, now the question to all of you is this, that while supposingly there is a case of a fees for technical service income arising in UK, fees for technical service income arising in UK. So therefore, if I go with the India-UK treaty, the rate is 20%. The FTS income, students, has arisen in UK. The FTS income, students, has arisen in UK. So my question to all of you, therefore, is that while interpreting the relevant treaty article for FTS as per the India-UK treaty, as per which 20% rate of tax is what is sought, as per which 20% rate of tax what is sought. Question to all of you is that can I superimpose the rate which is given in India-Singapore, which is at 10%, the rate which is given in India-Singapore, students, which is at 10%. So whether the 10% rate of India-Singapore, can that be superimposed in the treaty of India-UK, considering the circumstances which I already told to you? And what was the circumstances? That all of them are students OECD members. They have given to themselves the MFN status to each one of them. The MFN status has been given. So accordingly, the question to all of you is whether in this particular context, while interpreting the treaty of India-UK DTAA and trying to ascertain what would be the tax rate of the fees for technical service income which I've earned in UK. So if I go with the India-UK treaty, it becomes 20%. It becomes 20%. But the question to all of you, therefore, is whether I can superimpose the India-Singapore lower rate, concession rate of 10%, students, and put it in that particular transaction involving the income which I've earned in UK, and accordingly I pay the tax only at the rate of 10%. Is that possibility exist, students? To that, the answer is yes. To that, students, the answer is yes. If you have given a most favored nation, as the name suggests, students, if you have given the status of a most favored nation, then the name itself suggests that you have to then walk the talk, then show your particular, all the benevolency, that if you are treating some particular country as an MFN and there is another country which is also being given as the MFN status, so how this is possible that to one MFN country you are putting up the rate of 20% and to another MFN country you are putting up the rate of 10%? Now this is discriminatory, and that is the reason why this concept allows students, this concept allows herein that the rate of India-Singapore, which is at 10%, that could be superimposed in the FTS income which I have earned in UK, so that the beneficial rate of tax could be applied on such particular income. Now, students, obviously there are certain conditions to be fulfilled in this regard. And this case study, which the ICAI set up in the RTP, essentially tests you on that particular case, on that particular conditions part. But just remember what I have told you just now. All of them are OECD member. they have given to themselves the MFN status. And the next and the more important point, students, the first was the old treaty, which was India-UK. And thereafter, students, came the India-Singapore DTAA. So therefore, you are trying to put up the lower rate of India-Singapore treaty rate with the India-UK rate. What are the conditions that needs to be satisfied? Let's have a look to this particular case. The question is there in front of you, students. I think they cannot see this particular slide. I'll have to share it. Students, all of you, the question that has been there over here is question number 36. Question number 36, students. Now, in the question number 36, which is now there in front of you. Good evening, Sonia. So if you see over here, question number 36, very important question. Matrix INC dot. Students, again, I'm repeating the PDF file of Super 50, which is there. The notes, you can download it through the link which is given to you in the description box of this particular video. In the description box, students, of this particular video. So let's have a look. Matrix INC dot incorporated in country X holds 26%. Holds 26%. Holds 26% students of controlling interest in PILU Limited, an Indian company. So they are holding 26% in PILU Limited, which is an Indian company. PILU Limited declared dividend of rupees 50 lakhs during the previous year 21-22. The DTAA between India and country X, which came into force on 1st of Jan 2018. So when the DTAA students came for India and country X, it came on 1st of January 2028. And what was the rate of tax for the dividend? It was at 15%. Thereafter, so subsequent event, thereafter, India entered into a DTAA with country Y, which came into force on 15th of May 2018. So does it came after the first treaty? Yes. The India and country Y DTAA inter alia provides for concessional tax rate of 10% in respect of dividend. 10% in respect of dividend. Country X is an OECD member since 2015 and country Y is also an OECD member since 2017. Can you see that, students? So therefore, country X is an OECD member since 2015 and Y, students, is an OECD member of 2017. And the treaty, students, you can see herein as came later on. Now, Mr. Jack, a CFO of Matrix INC dot, seeks your opinion on whether the concessional tax rate provided in the DTAA between India and country Y can be availed by the resident of country X. So which treaty, students? DTAA between India and country Y can be availed by a resident of country X, and if so, are there any further condition to be satisfied in this regard? And if so, are there any further condition to be satisfied in this regard? So therefore, they want to you take the benefit of India and country Y particular treaty. Who wants to take the benefit? The resident of country X. The resident of country X, he does not want India and country X treaty rate. He wants the treaty rate of India and country Y. You may assume that the protocol annexed to India DTAA with all the OECD members countries contains the relevant tax parity clause. Parity means equality. So that is through the MFN status, the most favored nation status. When you grant, automatically the parity clause has to be accommodated in your treaties. And that is the reason why invoking the parity clause, if you are giving for FTS income, for dividend income, a tax rate of 10% in India country Y DTAA, then the same 10% also would have to be applied in applying for the treaty of India and country X. For applying for the treaty of India and country X. Would your answer change if country Y has become OECD in the year 2020? We will see that. Let's have a look. So this is the notification which I was talking about it. The CBDT has white circular number 3/2022 dated 3rd of February 2022, clarified that the applicability of the most favored nation clause and the benefit of the lower rate or the restricted scope of the source of taxation rights in relation to certain items of income, including dividend, provided in India DTAA with the third state, that is country Y in this case, will be available to the first state, that is country X, only when all the following conditions, students, are met. Only when all the following conditions are satisfied. So let's have a look. What are the conditions to be seen in this regard? Point number one, the second treaty with the third state. And what is the second treaty with the country Y? Is entered into after the signature or entry into the force of treaty between India and the first state. Please tell me, the treaty between India and country Y came after the treaty of India and country X? The treaty of India and country Y, did that came after the treaty of India and country X? And the answer is yes. And because of that reason, students, the condition is satisfied as India has entered into a DTAA with country Y on 15th of May 2018, after it has entered into a DTAA with country X on 1st of Jan 2018. So that is subsequent condition is satisfied. What is the next condition? The next condition, students, you can see the second treaty is entered into between India and a state which is a member of the OECD at the time of signing of the treaty. So country Y with whom you are signing the treaty at that particular point of time, was country Y the member of the OECD? We have seen earlier part of the question, because then there is a second question also. But in the earlier part of the question, it was very clear that first they became the member of the OECD and then thereafter the treaty was being entered. So therefore, to that extent, even these conditions are also satisfied. But if you see in the next particular second part of the question, what they are mentioning is that the treaty between India, the country Y became the OECD member somewhere in 2020. The country Y became the OECD member in 2020, whereas the treaty was entered in 2018, somewhere in the month of May. So therefore, in that situation, whether this condition will be said to be satisfied, answer is no. And because the condition is not being satisfied, therefore, the benefit cannot be obtained. That is in the second part of the discussion. Point number three, India limits its taxing right in the second treaty. India, students, is limiting what? The taxation right in the second treaty in relation to the rate or the scope of taxation? Yes. So the condition primarily is in respect of the dividend income. So this, they want to avail the benefit of the, it's not the entire treaty is what is superimposed. It is not the entire treaty which is superimposed. It is only the relevant portion of the treaty for which there is a concessional rate given in that treaty which was entered subsequently before the first treaty was being notified. So therefore, only a particular portion of the treaty which is to do with the tax rate of a particular income, only that is what is sought to be adopted. Only that is what is sought to be adopted. And accordingly, students, yes, that is also the criteria which is getting fulfilled, that I don't want to superimpose the entire treaty of country Y. I just need to extract the relevant portion of the treaty with country Y, wherein there is a concessional rate of tax which has been provided for. And thereafter, students, the government students, what they need to do? The government students, after this is done, they will have to, for country X now, because the country X still is at the old rate of 20%. So the government, by virtue of a notification, students, they need to tell that the rate of, say, dividend or the rate of any other income that will be considered would be that of the concessional rate of tax as provided in the treaty with country Y. So that thing needs to be captured through a notification, students. That thing needs to be captured through a notification. These are the conditions, students, that needs to be satisfied. Now, students, while answering this type of question, obviously now the fact that you may have understood this particular entire condition, my suggestion is that please don't write the entire condition as it is, because it will become very difficult for all of you to manage this particular theoretical part of this particular case study. Ideally, what you need to do, students, ideally what you need to do, you just need to use your common sense over here and try to use the factual data and keep writing through the factual data the various conditions. Like for example, one of the you can write like this, that one of the condition, students, is what? The condition is that the treaty with country Y should be entered after the treaty of the first country, which is country X, which is the country X. So that is a point. You give the reference of the case study itself. So you can say that yes, this condition is satisfied, and the condition is satisfied because the treaty with country Y is entered after the treaty with country X. Then the second one, students, what you are going to write, that at the time of entering with the treaty, at the time of entering into the treaty with country Y, the relevant the country Y is also the member of the OECD, which is also satisfied in this case. So therefore, you can say that since the country Y is also the member of OECD at the time of entering of the treaty, this condition is also satisfied. So this is the smart way of answering your question. I hope that all of you are getting this particular point, so that the examiner also understands what you want to convey, because many a time in writing some of the answers of very technical question, because we are not in a position to get hold with the technical language which has been used, the better approach would be to use the nominal language or the normal case study and use those case study to your advantage. Is that clear to all of you, students? Now we will go to our next topic after this, and that will be, students, on the capital gains front. On the capital gains front, students, and I will be doing the case study and the questions which are introduced in the latest RTPs and the MTPs, and we are blessed to have those questions which are in relation to what, students? In relation to the recent amendment which has taken place under the head capital gains. The recent amendment, students, which has taken place under the head capital gains. And what are the recent amendments? Let's have a look. So one is the amendment relating to the slum sale. Another is the amendment which is in relation to the partnership assessment. And the third one, students, is that of the ULIP taxation. The ULIP taxation, students. So there are 3 case studies, students, which has been there. I will first take you through to the amendment relating to the slum sale. Slum sale, students, what they have done is that they have changed the entire format of the computation. So far as the slum sale is concerned, students, they have changed the entire format of the computation, and with the new format of the computation, students, we will have to now compute the capital gains arising at the time of the slum sale. The capital gains, students, arising at the time of the slum sale. So let's look upon to this slum sale. Quickly, I just let you know. As you all are aware, students, so far as slum sale is concerned, this is to do with the transfer of the entire business undertaking. The transfer of what? The transfer of the entire business undertaking without assigning the individual value to the assets or the liabilities. The transfer of the entire business undertaking without assigning the values to the individual assets and the liabilities. So that is what you mean by the term slum sale. Now, in this case, students, if you can remember, the old provision was like this, that whatever in the case of slum sale, there is a separate computation that you have to do. A separate computation, students, that needs to be done so far as a slum sale is concerned. And when you do a separate computation, how you go about it, there is a full value of consideration. And after that, students, on the full value of consideration, there is a expenses of transfer which has to be reduced. The expenses on transfer, students, which has to be reduced, which will give you the net sale consideration. And thereafter, from the net sale consideration, you will reduce the cost of acquisition. And that is the cost of acquisition that will result into a capital gains. Now, the capital gains needs to be characterized as a long-term or a short-term. Now, the characterization of the capital gains as a long-term or short-term will depend upon whether the business undertaking is more than 3 years old or up to 3 years old. So if it is more than 3 years old, then in that particular case, we will say that this business undertaking is a long-term capital asset, and therefore it will result into a long-term capital gains. Now, what about the indexation benefit to be given if the business undertaking is a long-term capital asset? Whether the benefit of the indexation, is it available? To that, the answer is no. The benefit of indexation, students, is not available in this regard. So therefore, even that particular point needs to be considered very carefully, that no benefit of it, the indexation, students, is available in that particular context. Now, once you are done with this, let's now see what is the amendment all about. So earlier, before the amendment took place, students, earlier in this case, before the amendment took place, the valuation, full value of consideration was whatever the value, whatever was the consideration that was being received, primarily, that would be the considered in this case, whatever is the consideration amount that has been received, that is what used to consider as the full value of consideration. But now, after the amendment, students, after the amendment, the full value of consideration would be, in this case, the full value of consideration would be the fair market value. The fair market value, students, of all the asset which has been transferred in that business undertaking, the fair market value of all the asset which is transferred in that business undertaking, and that fair market value of all the assets which are transferred in the business undertaking, this will be compared with the consideration amount that is received. That will be compared with the consideration amount which is received, and higher of the two amount, the higher of the two amount, students, will then be considered as a full value of consideration. The higher of the two amount will be considered as a full value of consideration, students. Is that clear to all of you? So this is how the FVC has to be determined in this case. This is how the FVC, students, has to be determined in this case. So what you have received, that value will be compared with the fair market value of the asset which got transferred due to the slum sale process. So therefore, you have to take the higher of the two, and that higher of the two will eventually become the full value of consideration, and that thereafter the process will remain the same. The process will remain the same. On that note, students, we will quickly run through this particular case study, which is given to us here in this case by the ICAI material. Dhruv Limited, students, has 3 units A, B, and E. It transferred its unit E to Paras Limited. It transferred unit E to Paras Limited, students, by way of slum sale on 1st of April 2021. The balance sheet of Dhruv Limited as on that date is given below. So let's have a look in this context. So what has gone out is unit number E has gone out by virtue of slum sale. Thereafter, below this, if you see fixed asset, it has been given to you unit A, B, and E. Other assets, unit A, B, and E. So that is what the asset side is. And on the liability side, there is a paid up capital, reserves, and surplus. And then thereafter, the individual liability of each of the business undertaking. That has been given to you. Below this, if you see the additional information which has been given below this table, the additional information which has been given to you. Lump sum consideration on transfer of unit E is how much? 1340. Now this 1340 is the first consideration amount, and this first consideration amount will then be compared with the second amount, and then the higher of the two would be considered as your full value of consideration. So the additional information which has been given is the lump sum consideration on transfer of unit E is rupees 1340 lakhs. Fixed asset of unit E includes the land which was purchased at rupees 85 lakhs in February 2020 and revalued at rupees 150 lakhs as on 31st of March 2021. The stamp duty value of land on 1st of April was rupees 190 lakh, students. Now, students, over here, first and the foremost thing which I will just tell you, the best thing to get started with this slum sale in your examination, students, as you all know, full value of consideration, which would be the higher of the two amounts. Thereafter, the expenses on transfer, you get the net sale consideration. From the net sale consideration, you will reduce the cost of acquisition. So my question to herein is that you all students first try to determine the cost of acquisition. The first, students, has to be, even the first case, students, has to be what in this context? The cost of acquisition. The cost of acquisition. Now, so far as the cost of acquisition is concerned, primarily it is a net worth of the business undertaking which has been transferred. So net worth of the business undertaking which has been transferred. Now, how do you calculate the net worth, students, in this case? So while you calculate the net worth of the business undertaking which has been transferred, this is how you go about it. In the case of the net worth calculation, students, whatever is the, first of all, you have to see whatever is the income tax value, whatever is the income tax value of the asset, that is what you need to take, students. And what is the income tax value? The income tax value would be, so far as the depreciable asset of that undertaking is concerned, the depreciable asset of that undertaking is concerned, we always take the WDV. We always take the WDV, students. And thereafter, students, below that, thereafter, the non-depreciable asset, we will take the book value. We will take the book value. So first that comes to all of you, here is the land. The first that comes to you over here, students, is the land, which was purchased at 85 lakhs. So obviously, students, you will have to take up the book value because it is a non-depreciable asset. So in that situation, in the cost of acquisition, when you see the net worth, I will take up the value of the asset. Please be careful. I have used the word while you do the valuation of the asset minus the outside liability for determining the cost of acquisition, which is nothing but the net worth. That particular value of the asset needs to be split into two. One is the depreciable asset, will be at the WDV of the end of WDV of the asset, and the second one, students, is the non-depreciable asset for which you are going to take up the book value. So therefore, in the question, they will definitely give it to you that there are some revaluation that has taken place. So whenever they give you the revaluation as a concept, please do ignore the revaluation outrightly. Please do ignore the revaluation, students, outrightly. So here you have this 85 lakhs. That is what will be captured. Thereafter, students, you have been given something like revalued amount. Then the stamp duty value is also being given to you. This stamp duty value, students, amount we will consider while we decide for our fair market value of the asset transferred in that undertaking on account of slum sale. So at the time of calculating that particular consideration amount in which we have to take up the fair market value, at that point of time, we may have to use this stamp duty value of rupees 190 lakhs, but definitely not at the time of the cost of acquisition. Not at the time of the cost of acquisition. The next particular point was the other fixed assets represents plant and machinery and the furniture, which are reflected at rupees 835 lakhs. So other fixed assets represents what? The plant and machinery and the furniture. So in this particular case, out of the 985, 85 is gone. So this has become 900. This has become 900. Now, accordingly, the other fixed asset represents plant and machinery and furniture. Now, they are depreciable asset, which are reflected at 835. That is 985 lakhs minus the value of the, minus what, students? Minus the value of the land. Now, this value of the land that they are taking is a revaluation portion. But are we supposed to take up the revaluation portion? And the answer is no. So as per them, if we have to go with this, as per them, the other, if I have to just remove it, for us, I will take only 85. But what they have done, 985 is after evaluation. So minus 150, if I remove, so therefore I get the other value of the fixed asset. But again, I'm repeating this point, students. 85 is what only I'm going to consider so far as the cost of acquisition calculation is concerned, for which the land would be considered as for which the land would be considered at the book value because it is a non-depreciable asset. Because it is a non-depreciable asset. Now coming to point number 3, students, over here. Other fixed assets represents plant and machinery and furniture, which are reflected at 835 lakhs, which represents the WDV of those particular assets. So can I take this WDV, students? Can I take the WDV? But this is as per the books. You cannot take up the WDV because that is as per the books. I told you that the WDV that has to be taken has to be as per the income tax law. So it is the income tax value is what you need to consider, and therefore in that context, the WDV as per the income tax law that comes to students 725. 725. So it's 725 that will be considered over here in this context. After that, students, the other assets do not include jewelry, artistic works, shares and security. So in that case also, primarily for point number E, I will take up these are the non-depreciable assets. And hence for this also I'll take up the book value. The book value is 685. Nowhere in the question it appears that there is a revaluation that has taken place. So 85 plus 725 plus 685 and minus from this the liability, the outside liability of unit E. The outside liability of unit E, and if I have to go with the outside liability of unit E, it becomes 335, students. It becomes 335. So this minus 335, finally that will give you what? The net worth, and this is the net worth that you are going to pick it up in this case. So students, this is your net worth primarily, and that is, students, can you give me the calculation quickly? How much is the net worth in this context that will be considered as the cost of acquisition? How much will be the net worth that will be considered for the purpose of the cost of acquisition, students? Quickly. And indeed, the cost of acquisition, students, that you all can see, that will be considered would be 1160. Would be, students, 1160, Akash. And that is what we are going to pick it up over here. Now let's look upon to the full value of consideration. Now, so far as the full value of consideration is concerned, now, by the way, students, unit E, which is the business undertaking, which has been transferred. Unit E is a business undertaking. When did it got set up? 2020. And when the slump sale happened? 1st April 2021. Was the period of holding of that business undertaking more than 36 months? Answer is no. So the period of holding is not more than 36 months, and therefore will they be considered to be a short-term capital asset? And the answer is yes. Not that if this would have become a long-term capital asset, not that if this would have become a long-term capital asset that I would have given the benefit of indexation. I would not have done that. I would not have given any benefit of the indexation in this regard, but still your final capital gains would have been characterized as a long-term capital gains as against to this now, where your final capital gains will be characterized as a short-term capital gains. So students, now let's calculate the capital gains in this case, the STCG. If you see the STCG, students, over here, in this context, you have to first pick up the higher of the two. And the first one is 1340. Straight away, the consideration amount that you've received, the adjustment number 1. The first adjustment. Now, this would be compared with this is the first one, and this would be compared with the FMB value, number 2. And from this, you will minus what? 1160. And that will result into what? That will result into the final, the capital gains. Now, please be careful, students. In this case, this is the higher of the two amount. This is the higher of the two amount. So therefore, when we talk about the fair market value number 2, therefore, when we talk about the fair market value number 2, in that situation, you can easily make it out. Students, in that situation, you can easily make it out. And that is what? That is what, students, in this context. Point number 3, other assets. Other fixed assets represent plant and machinery and furniture, which are reflected at rupees 835 lakhs. So first of all, here in the first case of the land, let's look upon to the land. What is the value which I'm going to take up for the land? So in this case, so the value so far as the land is concerned will be the stamp duty value. Nobody can dispute on this particular part. So for the land, it will be the stamp duty value. Therefore, in this case, the FMB2 starts with 190 at first place. FMB2 starts with 190 at first place. Thereafter, for the other fixed assets, primarily representing the plant and machinery and the furniture, representing the plant and machinery and the furniture, students. What is that? We all get it. They are reflected at rupees 835 lakhs. They are reflected, students, at rupees 835 lakhs. Did you all got this one? 835 lakhs. And in this particular context, students, and in this particular context, what is that you are going to say about it? Or what is the value, students, that you're going to pick it up in this context? Will you consider 835 or 985 or 725 in this case, students? Which of the three values you are going to pick it up? First is for the other fixed asset I'm talking about, students, 835, which is in this case 835, which is the amount which represents even, students, which represents even in this context the book value. So will it be 835, students, in this case? Okay, or it would be the income tax value of rupees 725 lakhs, or it would be 985 lakhs, the outer amount. So land, obviously, students, you cannot consider because you've already considered in adjustment number 1 to be taken as 190 lakhs. But when you now take across the other particular points, when you now take into account the other particular point, students, then what is that you are going to get it? So if you see point number 3 in this context, you will take up, students, not the income tax value, but simply the book value. Other than land, students, for all the remaining item would be the book value that needs to be considered. And therefore, and obviously, students, if there is a money, bullion, jewelry, shares, security, money, bullion, jewelry, shares, security, if those are also given in the question, then for that also you will have to take up the fair market value. For that also, students, you will have to take up the fair market value. So this is how the fair market value needs to be considered in this context. So going by that particular proposition, students, we will take up the book value, which is for the other assets, primarily, which is for other than land or shares or securities or the money or bullion or jewelry. So other than these items, it would be the book value, and the book value that has been given to you is 835 lakhs. Book value, should not the income tax value which is required. So that is how the things has to be looked upon in this context. For the other assets which is there, again the book value is what would be considered. For the other asset, students, which has been there, again the book value that has been considered. And finally, students, finally what? Finally, students, you can see for yourself the herein also, while you determine the value of the asset, you will also have to reduce the liability. You will also have to reduce the liability, and the liability that can be reduced in this particular context, students, is what? The here in 335. 335, students, is the liability amount. And thereafter, students, which you can see over here clearly, you will get up the FMB value number 2. Now, if you have to just do a simple arithmetic, 1375, students, 1375, all of you are getting this. It has to be more. How come it? Yeah, minus 350. Yeah, I got it. Minus here in 335. So 1375, students, would be your FMB number 2. 1375 would be your FMB number 2. So which is higher of the two amount, students? Which is the higher of the two amount? Obviously, students, it is 1375. 1375. So therefore, it is 1375 is what will be considered as a full value of consideration. So therefore, the 1375 is what will be considered as a full value of consideration. Is that clear to all of you, students? So then 1375 will then be compared with 1340. So 1375 will be picked up. And from that, you will minus the cost of acquisition, which is at 1160. And that is what you are going to get the STCG. That is how, students, you are going to get it, the STCG. I hope that every one of you are clear with this one. That is how, students, you are going to get it, the STCG. Now, going it further, students, over here, what they have mentioned in this context, for computing the capital gains on the slum sale of unit C, for computing the capital gains on slum sale on unit C, what would be the deemed cost of acquisition and the improvement? So we already have seen. Now, friends, is there any improvement which is there in this regard? Cost of acquisition we already have worked out, which is 1160. Quickly, students. What is the cost of improvement in this particular context? Quickly. Obviously, students, this is where Charuta, the students really have gone wrong. And this is the way we actually end up reading the question very halfly. What the ICI does so intelligently is use some irrelevant information in the question so that they want the students to go stuck in this. They are saying beam cost of acquisition and the improvement for the purpose. Now tell me one thing, was there any information something to do with the improvement part of it? Answer is no. So whatever is the cost of acquisition remains, students, as the cost of acquisition, which is at 1140, and that is all of it. And the second particular question is this question. That's the reason why when the students don't read the question properly, they make these mistakes. So they keep searching, keep finding for both the data, which is the cost of acquisition and the cost of improvement. But they fail to realize that there is nothing in the question which suggests that there is an improvement that has taken place. And therefore, students, in this particular context, the improvement is nil. So therefore, it is 1140, which is the final part of your first part of your answer. And the second particular part of your answer, students, is about the capital gains, for which I think already we have seen 1375 minus 1140, which results into 215. So my answer, students, in this particular case is C. Okay, what is a tax liability, students? Now be careful. Now the short-term capital gains that you can see is 215 lakhs. Okay, now with that particular 215 lakhs, if you have to calculate a tax liability, so here it is, students, if you see it's a company. How much is the turnover, students? Did they mention anything about the turnover in this context? Turnover, students, for the last year, last to last year is 1455 lakhs. So please tell me then in that case, the normal tax rate for the domestic company whose turnover does not exceed rupees 400 crore. What is a normal tax rate for the domestic company whose turnover does not exceed rupees 400 crore? So therefore, the normal tax rate happens to be indeed 25%. So therefore, the tax rate that will be considered over here is 25%. So 215 lakhs into 25% is the tax rate. Plus for that, students, you will also load the surcharge element. And why 7% is a surcharge, as you all are aware, because the total income here in the short-term capital gain itself is at 215. So for a company, a domestic company, where the total income is between 1 crore to 10 crore, the rate of surcharge to be applied is 7%. After 10 crores, it will then be increased to 12%. Isn't it? In this context. So Akash, this is what it is. So 25%. In this context, this is where the mistake has happened, plus 7% of the surcharge, plus the HEC of 4%. Please tell me now the final answer in this case. 25 lakhs, take up 25%. Now on that 25%, whatever is the amount, Akash, still the answers is not correct. 215 lakhs into 25%, and whatever is the amount of tax, you will then add up the surcharge at the rate of 7% on that tax amount. And once you add up 7% surcharge, you will take the subtotal of the tax and the surcharge amount. Please take the subtotal of the tax and the surcharge amount. And after taking the subtotal, thereafter only you are supposed to load the surcharge incidence of 4%. The surcharge incidence of 4%. And because of that reason, students, with the surcharge incidence of 4%, finally, students, your tax liability will be 5983. 300, students. And that exactly is the point. 5981, sorry. 5981, 300 is your amount of tax, students. Now come to point number C. Beautiful questions are there, students. These are the beauty from the ICI. Have a look, point number 3. if Unit C was set up on April 9, 2009 instead of February 2020, so it's a long term. But even if it is a long term, will you give the benefit of indexation? Answer is no. Even if it is a long term, you will not be giving the benefit of indexation. So therefore, in that particular context, students, that you all can see over here, what is that we all get it? Students, we all get it over here. It's a long-term capital asset and the sale consideration is 3,500 lakhs instead of 1,340 lakhs. So obviously, students, your full value of consideration of 3,500 would be much higher as compared to your FMB number 2, which is somewhere around 1,375. So in this particular answer, 3,500 is what is going to be selected in computing the slum sale. Cost of acquisition already you know 1,140, and that is what will result into a capital gains. That is what will be resulting into a capital gains. So in this context, and the sale consideration is 3,500 lakhs instead of 1,340 lakhs, which would be the capital gains arising to Dhruv Limited, which is what, students, which would be the capital gain arising to Dhruv Limited on slum sale, and the resultant tax liability, the CI of financial year 9-10 and 14-18, is under section 148. Students, how much is 148 in this? Sorry, the CI of financial year 2009-2010 is 148, and financial year 21-22, students, is how much? 317. Is that CII you are going to use it for the indexation purpose in computing the capital gains under the situation of slum sale? Answer is no. Assume that there is no change in any other information given below. So what would be your answer? So obviously, students, in this particular case, what is that we are going to do? So here, students, in this situation, we will say that if the fair market value 1, which is your consideration received, is 3,500, then this will result into a long-term capital gains. And how much is the long-term capital gains? 1,190 minus 3,500. And that will result into 1,160, sorry, 1,160 minus 3,500, and this is what 2,340 is the LTCG. Now 2,340 students, 20% is the tax rate. 20% is the tax rate, students. Now, does it exceed by more than rupees 10 crore? Here in students, 20% of the total income, students, is 2,340. So in that context, students, obviously it's around 23 crores 40 lakhs. 23 crores 40 lakhs. With 23 crores 40 lakhs, students, herein at 20% tax rate, primarily my surcharge that will get escalated now, because my total income is more than 10 crores. My total income is more than 10 crores. My surcharge is going to be escalated from 7% to 12%. The surcharge is going to be escalated from 7% to 12%, and finally the HEC of 4% that has to be further loaded. And this is what, students, in this context would be all about. This is what, students, in this particular context would be all about. So therefore, finally the answer is, in this particular case, the answer, students, in this particular case is, how much is the amount of the tax in this regard? 545. 545.13. Akash, do the calculation properly. Somewhere there is a mistake which is happening again and again. Two, 340 into 20%. Whatever the tax amount, please add 12% of surcharge on that tax amount. Take the subtotal and then load the HEC of 4% on that subtotal amount of tax. And after loading that particular 4%, you will then be getting what? The final tax liability which is there in the case of slum sale. The tax liability which is there, which was been there in the case of the slum sale. Is that clear to all of you? So therefore, friends, our final answer is 2,340 and 545.13. Students, one thing I should tell you, one very intelligent way of solving the MCQ is to solve the MCQ partially. One of the intelligent way to solve the MCQ is to solve the MCQ partially whenever there are two options which are being given. Whenever there are some two options which are being given. But if the options are so close, like 2340, 2340. And then the second level of answer is also quite close enough in this context. In such particular cases, students, then you will not be in a position to find, in this scenario, students, you will not be in a position to, in this case, have a 100% authority without actually solving. You cannot have 100% authority without actually solving as to what would be the correct answer. Because see, if you see, the gap also is very, very thin, very, very nominal. So therefore, in this context, these type of questions, if you are going to attempt it in your examination, then these type of questions should be considered very carefully in this context. Okay, because here we will have to solve both. So should I be attempting it or should I think of leaving it? Maybe wisdom may prevail and you may think of leaving it. But now you don't leave it because you know the solution. But just for the sake of saying, I'm just letting you know. What would be the minimum alternate tax computed under section 115 JB for AY 2023 if the Dhruv Limited is located in, is located where? In IFSC and derives its income solely in convertible foreign exchange? And in such particular case, students, in such particular case, in such particular case, students, what exactly we will say? We will say this, that IFSC, what is the rate, students? Can anyone tell me what is the rate of MAT rate in the case of IFSC? Anyone? What is the MAT rate in the case of IFSC, students? What is the MAT rate in the case of IFSC? You should be knowing that, students. The MAT rate in the case of IFSC would be Akash Amruta. The rate is indeed 9%. Indeed 9%. Now, so far as surcharge is concerned, surcharge, students, for the purpose of MAT will be applicable with the same threshold of 1 crore and 10 crore. The threshold amount is same, 1 crore and 10 crore, but the criteria, students, for the surcharge, the criteria, students, for the surcharge would be what? The criteria for the surcharge, students, would be the book profit over here now and not the total income. Don't make this blunder, students. The criteria would be the book profit. So if the book profit exceeds rupees 1 crore, then the surcharge is 7%. If the book profit exceeds rupees 10 crore, then the surcharge is 12%. This is how the criteria is being decided in this case. Nitya. And accordingly, students, what we are going to say in this context, we will say, students, in this context that the book profit has been given to you. Here in point number 8, 320 lakhs. So 320 lakhs is 3.20 crore. 3.2 crore. So surcharge rate also would be at 7% because of book profit is between 1 crore and 10 crore. So here, students, is your book profit. $320 lakhs. Now, in this case, because it is located in IFSC, put up the MAT rate at 9% and get the amount. The surcharge rate, students, is at 4%. The surcharge, is at 7%. And the criteria is book profit exceed rupees 1 crore. The criteria is a book profit. So whatever be the surcharge amount, you will look into it, take the subtotal, and on the subtotal amount, add to that the HEC at 4%. And once you're done with that 4% HEC, final MAT liability, minimum voluntary tax, would be how much, students? All of you are getting the answer 32,04,804. 32,04,804, students. Congratulations. That is the correct answer. Congratulations to all of you, students. That indeed is a correct answer. I hope that all of you are clear with this. And again, the next question is one of the very important question. For IFSC, I can predict that the ICAI would be keen only in targeting the MCQs only. If you see point number 5 over here, please read this point number 5 and what they say. If Dhruv Limited is a company being a unit of an IFSC, deriving income solely in convertible foreign exchange and has distributed dividend of rupees 200 lakhs in the previous year 21-22, what would be the tax implication in the hands of Dhruv Limited and shareholders, students? What shall be the tax implication in respect of Dhruv Limited and the shareholders? So the answer, students, once it is IFSC, so neither IFSC would be liable for any dividend distribution tax. That is point number 1. That particular IFSC which is distributing the dividend, they will have no obligation for the dividend distribution tax. And moreover, now the shareholder who have taken the shares, the shareholders who have taken the shares, they also will be eligible for what? A full exemption, meaning thereby they will not have, in this particular context, they will not have these dividend received under the head IFOS. They will also qualify for the exemption in this case. So therefore, in that context, students, what will be the scenario? Answer is point number A, and that says no distribution tax in the hands of Dhruv Limited and no income tax in the hands of the shareholders in respect of dividend so distributed. The dividend so distributed, students. I hope that every one of you are clear with this one. All of you. So students, this covers up one of the most important integrated case study, and now I come to the another integrated case study, students. Unfortunately, that is there towards the end in the miscellaneous segment. I have to keep it, but that is one of the most important case study which has been there over here. Expected in your examination. Question number 48, page number 98. Page number 98, students. Now, students, first of all, let me give you the immediate quick reference of. There are, in the partnership for the capital gains purpose, there are 2 amendments that has taken place. One, students, is in 49B and another is, students, 45.4. Are you just getting this, students? 2 amendments has taken place, students. 45.4 and 9B, students. 45.4 and 9B are the 2 important amendments. And what are those? Students, in this context, what they are trying to say, be careful, students. In this context, what they are trying to say over here is this. In the case where, students, let's do first 9B. Let's do first 9B. 9B says that any distribution that you would have done Any distribution that you would have done, students, to the partners. Any distribution, students, that you would have done to the partner in the asset that has been distributed to the partner, either on account of, be careful students, either on account of what? On account of the change in the constitution of the firm, or on account of, one is the change in the constitution of the firm, and what about the second one, students? So first one happens to be the change in the constitution of the firm, and the second one happens to be the dissolution of the firm. So any particular asset which has been given to the partners due to this particular reason, it will not be considered as a taxable transfer. It will not be considered, students, as what? As a taxable transfer. Sorry. It is considered as a transfer and accordingly would be chargeable in the hands of the partner. In this context, it is considered as a transfer and accordingly, students, it is considered as a transfer, students. That is point number one, and accordingly would be chargeable. Now, question that arises to all of us is that chargeability under which particular head? So please see 9B placement over here. 9B, students, does not come directly under any heads of income. All of you will agree to this one. 9B does not come under any of the heads of income, students. All of you will agree to this one. And the fact that 9B doesn't come under any of the heads of income, therefore, what happens over here, students? So 9B, any transfer of the asset by whom? By the firm to its partner. And what is the reason? Either it is a change in constitution or there is a dissolution. Or there is a dissolution. So in such particular case, what 9B says? 9B says that there would be, or such transfer would be chargeable in the hands of whom, students? In the hands of the partnership firm. And the full value of consideration, students, the full value of consideration that you will take in this context is the fair market value of the asset which is transferred. Fair market value of the asset which is transferred. Here the question that comes in our mind is that in which head, students, in which head it will be transferred? Will it be transferred under the head PGBP or it will be transferred under the head capital gains? That will depend upon what is transferred to the partner. So the asset which has been transferred to the partner, if it is the stock in trade of the firm, if it is a stock in trade of the firm, then in that case, it will go under the head PGBP. Whereas if the asset which has been transferred happens to be a capital asset, then in that particular case, students, it will go under the head capital gains. Then in that particular case, students, it will go under the head capital gains. And that is the reason why the amendment has been given to you in section 9B. The amendment, students, has been given to you in section 9B. I hope that all of you are clear with this one. I hope that all of you are clear with this one. So this is what your 9B, students, is all about. Okay. The second particular point, students, and on this basis, thereafter, the capital gains computation, students, that you are going to do would be done normally. Only if supposingly it is a capital asset which is transferred, then the question that arises to all of you, sir, how we are going to calculate the capital gains? The capital gains calculation thereafter would be done normally, which implies that if the asset which has been transferred is a long-term capital asset, then you will definitely be providing the indexation in this context. You will be providing the indexation and therefore the long-term capital gains or loss, that is whatever has been computed, will be there. So it's a normal computation, friends. What I'm only trying to say is that it is a normal computation. I hope that all of you are clear with this one now, at least so far as 9b is concerned. And if 9b is clear to all of you, this results into our next discussion, and which is about 45.4. This is an issue, friends. $45.4. Students, first let me explain to you 45.4. Hopefully by after the explanation, it should come into picture. All of you should just pay attention what I'm saying in this context. 45.4 students is for what? 45.4 students is applicable in the case of the change in the constitution of the firm. Meaning thereby 45.4 students is not applicable in the case of 45.4 students is not applicable in the case of what? In the case of dissolution of the firm. Just keep that point in mind. One by one, students, I'm going to take you through to each and every aspect very systematically. So 45.4 is only restricted to the change in the constitution of the firm, and it does not extend to, students, it does not extend to the dissolution part. Now, on that, if there is a change in the constitution of the firm and the partner is being given some of the assets, say for example, retirement of the partner, and the partner, say for example, has been given, say, some of the assets or maybe some money, then what happens is that, students, in this particular case, on such particular transfer which is made to the partner, on such particular transfer which is made to the partner, the capital gains would be computed in the hands of the partnership firm. The capital gains will be computed in the hands of the partnership firm. Now, how to compute the capital gains in the hands of the partnership firm, students? How to calculate the capital gains, students, in the hands of the partnership firm? So here is how you will calculate the capital gains. Here is how you are going to calculate the capital gains. Point number one, be careful, students. The capital gains that has to be computed is going to be A plus B minus C. Here in students, A plus B. One query that comes in the mind of the students. There is one very popular query comes, sir, why you are calculating the capital gains? Just now you have calculated the capital gains herein of just now, some time back in 9b you have calculated the capital gains, because 9b is applicable for both change in the constitution of the firm as well as the dissolution of the firm. And now you are saying 45.4 is applicable only in the case of the change in the constitution, and then you are again calculating the capital gains. So this is a double particular levy of the capital gains, one in 9b and another is 45.4. No, this is not a double levy, students. Be careful. This is a beautiful concept which is introduced by the SSC, by the government, students. And what is the concept? Concept is like this. Students, in the case of 45.4, the chargeability is not in respect of, be careful, the chargeability, students, is not in respect of the asset which has been given, to the partner, because why I'm saying so? Because so far as the asset which was being given to the partner, you already have charged in 9b. So therefore, the chargeability under section 45.4 is in respect of something else. So therefore, the question arises, sir, what is that something else on which the chargeability of section 45.4 is dependent upon? So this chargeability under section 45(4) students is in respect of, do you know what it is? The partner gets one asset, say for example land. The firm may have other lands also, other assets also. Those are the assets which are there in the firm as on the date of what? Date of the change in the constitution of the firm, isn't it? Now the partner will say that fine, you have given me the land, but at the same time I have the right in all these assets of the firm. Just before my retirement, do I have the right on all these assets of the firm? Do that partner have the right in all these assets of the firm? Answer is yes. The partner have the right in all the assets of that particular firm, and because that the partner have the right in all the assets of that particular firm, therefore students, therefore what? Therefore students, in this particular case, the partner is surrendering those right. The partner is surrendering those right of the remaining asset in the firm to the partnership firm, and therefore on the surrender of his right in respect of the remaining asset to the partnership firm, on that surrender, will it be considered as a transfer? Yes, and hence the firm is chargeable to capital gains in the hands of whom? The firm is chargeable under the head capital gains, that is under section 45(4). So the charge of 45(4) is a very unique charge. It is not in respect of the asset which is transferred. It is in respect of the surrender that the outgoing partner has done in respect of the assets which is there with the firm as on the date of, as on what? As on the date of his retirement. So in respect of the surrender, that the charge of 45(4) is attracted. I hope that all of you are clear with this one. In respect of the surrender, that the charge of section 45(4) is attracted. Yes, one may argue, but sir, the partner has surrendered it. So the partner is a transferor. So the chargeability should be attracted in the hands of the partner. Yes, you could have said it, but the chargeability students here, it is attracted in the hands of the partnership firm also. It's like a reverse charge. It is like a reverse charge. So here, in respect of the surrender that has taken place on the balance asset, the surrender of the right of the outgoing partner in respect of the balance asset, it is the firm which is going to be liable for the charge of the capital gains. It is the firm which is going to be liable for the charge of the capital gains. So therefore, now the question that comes, how to calculate the capital gain, students, in this regard? The question that comes, how to calculate the capital gain in this regard? So students, 45(4) talks about the chargeability over here. So the computation that you do, so here in 45(4) says A is equal to B plus C minus D. A is equal to B plus C minus D. Now, what is A is equal to? A is a capital gains. A definitely would be finally the CG. What is this B, students, over here? The B, students, in this particular context, the B, students, in this particular context is the money which has been paid to the partner. Money paid to whom? To the partner. That is your B. The C over here, students, in this case is what? The C over here, students, is the fair market value of the asset transferred. Of the asset transferred. Of the asset transferred. And last is the D, students. The D I'm going to decode, students, but just allow me, students. My network has hanged. So just allow me, students, 5 minutes. In the meantime, I want all of you to read question number 48. Question number 48, page number 98. You all will download the PDF from this description link. And just allow me 5 minutes, students. I think the system is because the computer was on right from the morning. Just allow me 5 minutes, 5 minutes break. In the meantime, students, all of you will start reading question number 48, page number 98. Question 48, page number 98. I just have to exit and then I'll enter after 5 minutes. Okay. Nitish, I'll just join in around 5 minutes after the break.
Yes, sir.
So students, welcome back. Now students, on this particular part, what we're discussing was in respect of. So students, welcome back. A plus B. So I hope that all of you have got hold with the conceptual part of it. The conceptual part of it, students. The charge of section 45.4 is different from the charge of section 9B. 9B is for the asset which has been transferred to this particular partner. That is what this charge of 9B is all about. But when it comes to section 45.4, that charge is in respect of the surrender of the right of the partner in respect of the remaining asset which he has left, Amruta, which he has left with the partnership firm, And therefore, students, in this case, Akash, we have to do with this A plus B, and I've told you about what is A is a capital gains. In this calculation, A would be the capital gains. B is the money which has been paid to the partner. C, students, is the fair market value of the asset. And the D, students, D is a game, real game. What is that you're going to minus? Students, here, the D that you have to minus is the balance of what? The partner's balance, the outgoing partner's balance as on the date of his retirement. The outgoing partner's balance as on the date of retirement. This is the real game, students. The outgoing partner's balance as on the date of retirement. This is the real game. And that is the real game that we are going to play by virtue of question number 48. Question number 48. I hope that all of you are ready with this. Then question number 48. Students, in the question number 48, let us look upon to this. Mr. Prem is a partner. Now, A plus B plus all the figures, students, I'm going to explain you through the practical so that conceptually I have made you understand what exactly it is. But now, through the numericals, which is this case study is the ultimate case study, on the day of the examination, students, you will revise one more time and that should be all. So, Mr. Prem is a partner in two firms, X and Company, Mumbai, and Y and Company, Delhi. So, two firms, students. He is a partner in two firms. X and Company has 4 partners, including Prem, which are sharing equally. So, it means 1/4. Mr. Prem resigned from X and Company on 1st of April 2021. So, that's the date of his resignation. On the said date, the capital balance of each of the partners stood at how much, students? At rupees 32 lakhs. That is the capital balance of each of the partners stood at rupees 32 lakhs. So that is the opening balance. But be careful. The share of the outgoing partner not only comprises of the opening balance plus also whatever is the left out, that share also is to be included in this case. That share in that income on those particular thing has to also be considered. We'll see one by one everything. So if each of the partners is rupees 32 lakhs, in order to settle the dues of Mr. Prem, the firm revalue its land for the first time since purchase. The valuer also valued the self-generated goodwill at 70 lakhs. So this is the first time, students, the valuations are being done. The firm has the following capital asset whose details are as follows. Now let's have a look, students. What are these particular assets whose information has been given to us? And we'll have a look on this. So land at Pune, students, which is on this date of purchase is given to you. The book value, which is the cost of acquisition, that has been given to you, which is 15 lakhs. And the value as per the valuation report, meaning thereby as on the date of retirement, how much is the value? 50 lakhs. At Nagpur, students, the date of purchase, the book value, which is actually the original cost, you will find the date of retirement, what is the valuation which is there. In Mumbai, students, it is 1st to 14th of May 2013. And thereafter, students, 88 lakhs is the cost of acquisition. That is fine. That is a book value. And thereafter, students, it is 250 lakhs as on the date of retirement. And the self-generated goodwill, please note one thing, self-generated goodwill, students, is not will not have any cost. It will have a nil cost, isn't it? And because of the fact it has been self-generated goodwill has been valued for the first time as on the date of the retirement of that outgoing partner, Mr. Prem. So therefore, its value is how much, students? Rupees 70 lakhs. Its value, students, is how much? Rupees 70 lakhs. This is what it is, students, in this context. Now, in April 2021, X and company gave land at Nagpur and rupees 15 lakhs, students. Be careful. Now, this X and company is giving land at Nagpur. So, land has been given at Nagpur and 15 lakhs of money to Prem to settle his capital balance. Please tell me one thing. When you do 9B calculation, students, I'm talking about that only. The 9B calculation, when you all will do at that particular point of time, whether in this situation will you be getting into the what is that the value that you're going to take as a full value of consideration. Two options. Option number one is only the two options, students. Option number one is I am going to take only the value of the land as on the date of the retirement as the full value of consideration. And the option number two is I am going to take up both the value of the land as well as the money which has been transferred to the partner as on the date of his retirement. So both is that what you will take as the FVC for 9B computation, or you will do 9B computation only with the value of the land as on the date of his retirement. What is that for 9B only? I'm talking about it, students. Please tell me quickly in this case. For 9B students only, I'm telling to all of you. Quickly. Amrita. Indeed, it is only the value of the land that has to be taken, students, in this regard. And therefore, let's calculate immediately, students, 9B. So 9B capital gains will be calculated normally for the Nagpur land. So here in the full value of consideration that will be considered would be, in this case, 45 lakhs. And less ICOA, index cost of acquisition, students. The index cost of acquisition that you will take would be the CII of 1516, students. The CII of 1516, the CII has been given 1516 254, and the current CII which has been there for all of you 2122 317 to 254 and 317, students. So therefore 25.4 into 350 317, 25.4 into 317 divided by what, students? Divided by 254. Can you give me, students, ICOA figure? The index cost of acquisition or resultant capital gains? Resultant capital gains, students, in this case, quickly. Resultant capital gains, students. So ICOA 31.7 and the resultant capital gain is 13.3 lakhs. So 13.3 lakhs, students, is the resultant capital gain, students. All of you agree to this proposition? Every one of you agree to this particular proposition, students? And that exactly is the point. That exactly is the point, students. So this is how the capital gains will be computed in this context. I hope that all of you are clear with this one. And this would be a long-term capital gains. Long-term capital asset, so long-term capital gains of 13.3. Fine, so 9B calculation is over. Now we come to our next calculation, students, which is of primary of the next one. So 9B, students, I'll just now erase this particular part and just simply write herein so that this does not look messy. So 9B, students, I'm directly writing long-term capital gains of 13.3, which you have calculated. Taxable in the answer of the firm. Now let's look upon to 45.4. 45.4. So when it comes to 45.4, the capital gains, which is known as A, B plus C minus D. Now B is the money value. How much money has been given? 15 lakhs. C is what is the asset that has been transferred? We already know 45 lakhs. And now D, students, D is a game. D is a real game, students. You have to be very careful in the calculation of D in this case. For the calculation of D, students, be very, very careful. D, students, as I told you in this particular case, is the opening balance. We already know 32 lakhs. But then there is also students, in this context, one of the asset that got transferred, in which the firm got the income. The firm got the income, students, and the firm got the income on the transfer of the asset, isn't it? Now, how much? Now, these are the book value, students. Now, when you talk about the income part of the firm, these are all on the book values. So the income part of the firm is 45 lakhs. The 45 lakh, students. So I am just trying to build up my opening balance. I'm just trying to build up my opening balance as on the date of retirement, and the balance as per the books. The value also should be as per the books. Then if the balance is as per the books, then the value also should be as per the books. So how to calculate the value as per the books? So just again, there was an income to the firm on the date of the retirement. So that income would be distributed with all the partners equally. Which income, students? The income that we have calculated on the transfer of the asset. So therefore, in this particular context, 45 lakhs minus from this 45 lakhs, students, what is that you're going to minus herein? The book value of the asset. The book value of the asset, because we have to determine the book value as the balance as per the books, which is standing of the partnership of the partner, outgoing partner, as on the date of his retirement. So everything would be as per the book value. So for the income on the transfer of the asset, which is accrued to the firm, that income also will be determined as per the book value. So this is what it is. Now this, students, as you all are aware, in this context, this all of you are aware in this context, students, what you are going to do. So 25.4. Now from this 25.4, that there would be a tax also that will be charged. There would also be a tax. Obviously, the tax will reduce. Obviously, whatever is a book profit, 45 lakhs minus 25.4. This is a book profit. Against that, you have already paid. There's a tax which would be paid in this regard. There's a tax, students, which is there in this regard. And what is the tax amount? Just now, students, can you calculate the tax over here? So here 13.3 lakhs into 20.8%. The capital gains rate, long-term capital gains plus HEC. So the tax amount works out to be, how much is the tax? I think I've already calculated this one. 2.7664 is the tax amount. So 2.7664, students, in this context. Now be careful. This is the income which is there for all the four partners. This 45 lakhs minus 25.4, which is the book value, minus the tax amount 2.7664. This is for all the four partners. Now I need to divide for Mr. Prem, who is the outgoing partner. So therefore I need to divide it by 4. And now by dividing it by 4, students, how much is the amount that I'm getting it over here? 45 lakhs. Please do this one quickly. 45 minus 25.4, which comes to 19.6. So 19.6 minus 2.7664. How much is that, students? And then divide by 4. 19.6 minus 2.7664. That will be divided by 4. And then, students, in this particular case, this entire amount would be divided by 4. After divided by 4 would be how much? After divided by 4, students, it would be how much amount? 45 lakhs. 19.6 minus 2.7664, which is 17.2336. 17.2336. Please divide this by 4. 17.2336, which is the income as per the books, divide by 4. So therefore, after dividing by 4, the partner share comes to 4.084, 4.3084. So now take the total 32 lakhs opening balance and the income calculation which is there in this context, which is 36.2084. So 36.2084 is your D. 36.804 is the D, students, which is the capital gains. The capital gains in whose hands, students? This is the capital gains which is there in the hands of the partnership firm. This is the capital gain, students, which is there in the hands of the partnership firm. Amrita, Akash, the answers are coming different. Can you just once quickly run through the same? Okay, so this is 16.8336 divided by 4. So is 4 point, students, is 4.2084. So what is the value of my D? So the value of my D is 36.2084. So this would be my D then. Now, B plus C minus D. D I have calculated just now, 36.2084. B is 15 lakhs. C is 45 lakhs. So 60 lakhs. 60 lakhs minus 36.2084. 60 lakhs, students, minus 36.2084. This comes to how much? This is your final A. So your A in this case would be 60 lakhs minus what? 60 lakhs, which is B plus C, minus 36.2084. This will result into A. And the A will be how much, students? Quickly. In this case, the A, students, will be how much in this case? 23.7914. 23.7914. So what is this gain? This capital gain is not in respect of the asset which is transferred, students. This capital gain is not in respect of the asset which is transferred. This capital gain, students, is actually in respect of the asset which is left out. So therefore, in respect of the asset which is left out for this particular partner who is surrendering his right, so that partner who is surrendering, students, his right, this much of the gain is in respect of the remaining asset. This much of the gain is in respect of the remaining asset. Now, which is the remaining asset, students, in this case? So the remaining asset, students, in this case is the asset in Pune, asset in Mumbai, and the self-generated goodwill. Do you all get this one? 3 assets are there in this case. Assets in Pune, assets in Mumbai, and one is a self-generated asset. So 3 assets are there. Now Pune, is it long-term? The Pune asset, is it long-term? Yes, it is long-term, period of holding. What about Mumbai? Is it long-term? Yes, it is also long-term. And self-generated asset, when it came in existence, when it got valued, just on the date of the retirement, that is 1st April 2021. And therefore, this will be a short-term capital asset. So there are 2 long-term and 1 short-term. So therefore, students, this capital gains, this is a capital gains. Now this capital gains needs to be bifurcated between long-term and short-term. I told you just now that this capital gains is in respect of the future asset for which this partner has surrendered his right. This capital gain is attributable to the right of the outgoing partner which he has surrendered. This capital gain is attributable to what? To the right of the outgoing partner which he has surrendered. So therefore, we need to bifurcate the capital gains now. How do we bifurcate the capital gains? So with this 23.796, students, with this 23.796, the bifurcation, the split 2:1. So there would be 2 long-term and 1 short-term. 2 long-term and 1 short-term. So 2 long-term and 1 short-term, students. So which are the long-term herein? This is the long-term, 50 lakhs, Pune. Mumbai is also long-term. Mumbai also long-term. So take herein, if you take into account in this particular context, Mumbai and Nagpur, sorry, Mumbai and Pune, they represent the long-term assets. Mumbai and this one, they represent the long-term assets, students. Do you all get this one, students, in this context? Fine. And what about the case for this particular part of self-directed asset? This is a short-term one. Short-term one. Now, in that particular context, students, we will now need to take up the ratios for the same. The ratios. Now, tell me one thing. How much is the increase in the value? 35. 35 is the increase. The incremental value, primarily, which has got increased. The incremental value vis-a-vis the book value is how much, students? In this case, 35 lakhs. The increase in the value, which is there. How much is the increase in the value in this case? So the increase in the value, students, sorry, not the second one. Second one is told. The third one. Increase in the value, students, over here is how much? 162. And the increase in the value is how much? Students, 70. So therefore, the revaluation that has happened, students, that has happened will be in the form of 35, 162 and 70. 35, 162 and 70. That is the increase in their value. There is an increase in the value. So what happens now, students? Therefore, what I'm going to do, the 2 long-term, which are the 2 long-term? 25, 35 and 62. 162, which comes to how much? 267. Sorry, 197. This is 35 and 162, students. Comes to how much? 197. And 1 short term is 70. 1 short term is 70. So let's take a split. So 70 divided by 267 and 297 divided by 267. 70 divided by 267 and 197 divided by 267. Can you tell me the prorata? 70 divided by 267 and 197 divided by 267. So in that particular case, 70 divided by 267 comes to 6.2374 lakhs. 6.2374 lakhs. And for this particular part, to 197, this ratio applied on long-term capital gains. 197 divided by 267 applied on the long-term capital gains, or on the capital gains of 23.9, this thing. So this comes to, students, 17 lakhs 55,480. 17 lakhs 55,480. So student, this is your short-term capital gains, and student, this is your long-term capital gains. So one is short-term and another is long-term. So short-term capital gain is 6.2374. Short-term is, in this case, 6.2374, and the long-term, students, is 17,55,480. 17,55,480, students. This is your long-term capital gains. So now, therefore, now you will say, sir, but this is relating to the future asset, for which whatever is the increment that has happened, on the transfer of the right of the outgoing partner in these assets, on that the capital gain is 23.796, and then that capital gain is bifurcated vis-a-vis the long-term and short-term in the ratio, revaluation ratio. So the revaluation ratio is what is taken for the purpose of calculation. So therefore, the question to all of you is that tomorrow, students, when these assets, now obviously the partnership firm will have to pay the capital gains tax on 17,55,480 at the rate of 20%, and on 6.2374 at the normal rate. So the partnership firm is paying the tax today itself. Now, tomorrow, students, whenever these assets would be sold, then in that case, again, there is a capital gains, and then you will then compare the actual cost and the selling price. All those calculations will come into play. So don't you think that in that particular case, there would be a double taxation? because some portion of the value which is attributable to the right of the outgoing partner in those assets, that portion of the value is already being taxed. So tomorrow when these assets are actually sold, so that will result into a double taxation. Tomorrow when the assets are actually sold, then that will result into double taxation. And therefore, to ensure that such double taxation doesn't happen, whatever is the capital gain amount that we have calculated, that will get reduced in the subsequent calculation. That will get reduced in subsequent calculation. How it will get reduced in subsequent calculation, I will show you in the MCQ itself. So just quickly run through this one, students. So I will now tell you two things, students, you have to always revise. Now in the next 15 days or so, students, two things you will remember it, because you should not get confused on the day of the exam. Which are the two things? This A plus B plus C minus D. The D part is what you will revise always. First of all, understand that 45.4 is in respect of the capital gains to be calculated by the partnership firm, which is attributable to the surrender of the right of the outgoing partner, the surrender of the right of the outgoing partner in the remaining asset. That is what this 45.4 charge is all about. In that particular charge of 45.4, D is the crucial one. And the D part, students, whenever you revise, you will revise like this, that the opening balance, book value, which is the opening balance of the capital of the partner, outgoing partner, add to that, then the income on this asset, which is there, even that will come into play. The income on the asset which has been transferred to him, that particular income, but the income will be the book value, not the income tax value, because it is on the opening book value that you have to add this income. And that is the reason why on this 32 lakhs, you will then consider the income on the transfer of the Nagpur property. So that also gets captured in the calculation. But on the basis of the book value, don't forget to reduce the income tax liability arising thereon, which you have already computed earlier. The long-term capital gains on that 28.8% will get the income tax liability. And thereafter, students, in this case, whatever is the income, which is the book value minus the income tax that you have calculated, that income relates to all the four partners, divided by 4, so that how much is a share of the outgoing partner is known. Then that share of the outgoing partner primarily would be added to the opening balance, that will result into D, and then you get your A, and that A is nothing but, students, the share of the capital gains, which is attributable to the share of the outgoing partner on surrender of the right in the remaining asset. So therefore, since it is to do with the remaining asset, this capital gains character also needs to be defined. The capital gains character also needs to be defined, and the character that will be defined would be going to the remaining asset, checking what is their nature. And once you check the nature, accordingly, students, you will then come to know that these are the long term and these are the short term. Accordingly, club the long term and club the short term, and thereafter, whatever is the revaluation ratio is the split that you are going to take. Revaluation ratio is the split that you are going to take on A, and on that basis, you will finally determine how much is your long-term capital gains, or for how much is your short-term capital gains. And that is the final amount. Now, on that, this is what, students, you need to revise. So keep this particular, I will recommend to all of you also that once this video is over, just to keep this video and just see the timeline of this particular video. Hardly this 3 minutes revision, I have done this quickly. Okay, so this 3-minute revision is what you will keep on revising it again and again, so that on the day of the examination, you don't wonder what exactly is the scenario over here. So what will be the amount taxable under section 9B in the hands of the firm X and company, Y and company? We will just do the X and company, students, herein. And the answer to that is this one. 13,30,000 already have calculated. For Y and company, I'm not calculated, but I'm just telling you this is what would be the answer. It will become just a time. We can do this if you want, but just telling you 13,30,000 we have already calculated it for 9B. In that case, this is what it is. What would be the capital gains taxable under 45.4 in the hands of X and company? 45.4 now they're talking about it. Now the characterization is the key, and we just have calculated in this context. And what is the amount, students? This is the amount that we have calculated. This is the amount that we have calculated, students, in this context. The nearest 10 is what we will pick it up. The nearest 10, students, is what we are going to pick it up. And that is what, students, it is 17,55,410. And thereafter, students, the next one is 6,23,750. 23,750. So this is what it would be, point number C. Now this, why, students? What would be the capital gains under 45.4? Now see here 45.4. 45.4 is what? 45.4, tell me one thing, students. Is 45.4, now you have to tell me YN company is dissolved on 1st of March 2022. YN company is dissolved on 1st of March 2022 and distributed its land at Chandigarh, Mohali and Gurgaon on same date to its partner Prem, Akshay and Arav respectively, who were sharing the profit and loss account equally. The particulars of these land are given below. Please tell me, 9B, is it applicable? Yes, I'd already gave to you. 9B is all about the transfer of the asset. So whether the transfer has taken place at the time of the change in the constitution of the firm or whether the transfer has taken place at the time of dissolution, 9B will always be applicable. But what about in the case of, students, what about in the case of the other one, 45.4? Is 45.4 applicable in respect of the dissolution of the firm? 45.4, is it applicable in respect of dissolution of the firm? To that, the answer is no. And why I say the answer is no? I already told to all of you students in this regard. Didn't I told you, students, as far as 9B was concerned, didn't I told you, students, in this context? What was that? Remember that one, students? I already told you, students, in this regard that so far as 9B is concerned, I already told you this particular point. Both is covered, but 45.4 is the capital gain in respect of the remaining asset. Share of this particular outgoing partner in the remaining asset, that share is what is getting taxable in the hands of whom? In the hands of the firm. Tell me one thing. Does 45.4 applies at the time of dissolution of the firm? Does 45.4 applies on the time of dissolution of the firm? Answer is no, because there is no remaining asset at all at the time of dissolution, and hence 45.4 is not applicable in this case. Only 9B is applicable. So as far as answering this question is concerned, what would be the capital gains under 45.4 in the hands of YN company? And the answer to that would be nil, students. And the answer to that, students, would be nil. Now this is the beauty. Now here, what would be the amount apportioned to the land at Pune and land at Mumbai to be reduced from the full value of consideration for computing the capital gains when sold in future? Now, by the way, how much was this one, students? 17,55,410. Both were them land in Pune and land in Mumbai. Both of them were long term, isn't it? And the revaluation ratio, students, we have seen. And the revaluation ratio that we have seen, students, was 35 and 65. 35 for Pune and 162 for Mumbai. So therefore, the total was 197 in our particular case. But now, if I have to ensure that subsequently, whenever this particular asset is transferred from their full value of consideration, this much of the value already was taxed earlier. So just to ensure that there is no double taxation, that I'm going to remove this particular amount. Students. And therefore, this is the point. 35 students and 162. So if you give me the ratio in this particular context, students, if you give me the ratio, the answer would be this. The answer would be this, 3 lakh. Just you can do the ratio if you want. It has to be 3,11,875 and 14,43,535. So this is how the ratio will be looked upon in this context, and that exactly is the point. And the final question which is there, students, in this case, is about if the self-generated goodwill is sold in previous year 22-23. So it is sold, 80 lakhs sold. What would be the capital gains? Now from this capital gains, students, that minus, already we have calculated the capital gains. How much was that? Which was taxable earlier. So full value of consideration will be reduced with the capital gains tax earlier, which is that amount 6,23,750, and the cost of acquisition is otherwise nil. So therefore, finally, students, the answer would be 80 minus 623,750, and that will result into 73,76,750. Is that clear to all of you? One of the beautiful case study, students, which has been there in this regard. Beautiful case study, students. One of the beautiful case study, students. Do you all agree to this one? And this primary, students, is the best of the lot of the ICI. And this, if it comes in the examination, students, it will be terrific. It will indeed be terrific, students, in this context. So, students, in this context, now, students, as I told you earlier, also one more session is left. ICI will be placing this particular session. Now, you say, sir, from where we will get the details? Details, as you would have subscribed to this channel, that is one. Secondly, I will also put the details of this lecture in my Telegram channel also, so that those who are there in my Telegram channel, I'll just tell you the Telegram channel name is CA Durgesh Singh. The name of the Telegram channel, students, is CA Durgesh Singh. I'll just put that particular link of the video of the final class also in my video in this case, so that you all are primarily updated with the one more session which we are going to have it on the TDS, TCS, and the remaining assessments and all which are there. Those will not take much time, because you have to do a lot of calculations and all. So that's the reason why it takes a lot of time, but worth it, because these are the very tricky and important concepts. Come to question number 6, students, over here. This is the last amendment which is there on the capital gains front. And this is about this, if you remember, students, with effect from 1st of February 2021, the scheme has changed. Earlier, what used to happen was that there was an exemption under section 1010D. Students, there was an exemption under section 1010D, and what it used to say is that supposingly you have taken up a policy, students, on or after 1st of April 2012, then in that case, the premium should not go more than 10% of the sum assured. The premium, students, should not go more than 20%, 10% of the sum assured. If the premium does not go 10% of the sum assured, students, then in that particular case, you will be eligible for what? You will be eligible for exemption on the maturity. Same case, if the policy is taken before 1st April 2012, students, then in that particular case, you will be getting the premium that is paid should not exceed 20% of the sum assured. The premium that is paid should not exceed 20% of the sum assured. In that particular case, whatever is the amount that you receive in the maturity, that will be eligible for a full exemption. That will be eligible, students, for a full exemption, students. And that is what, students, they have mentioned it over here in this context. Isn't it? There is also, apart from this, students, there is also one more important point. And that particular point is about the ATC deduction on the payment of the LIC premium. So whenever you pay the premium, then whatever is the percentage that I have told to all of you, which is 10% of the sum assured, that or 20% of the sum assured, depending upon when the policy was taken, that much of the cutoff percentage would qualify for deduction of ATC. But the aggregate upper limit of ATC, students, 1.5 lakhs. Aggregate upper limit, students, all of 1.5 lakhs. So 1.5 lakhs happens to be the upper limit. This is what it is. These are the existing provision. Now, what has happened, students, with effect from any policy that you would have taken on or after 1st of February 2021, the amendment kicks in. And what is the amendment? 1st February 2021, do remember this date. 1st February 2021, any particular policy that you may have taken, students, the amendment will come into play. And what is this amendment? As per this amendment, students, what it says is this, that as per the amendment, students, what it says is this, that amendment, students, I'm talking about it now. It says that not only that the percentage would be seen, but also what we will see is that whether the annual premium aggregate of all the premium that is paid, is it up to rupees 2.5 lakhs? So even though you may be within the percentage, but if I take up the aggregate premium that you have paid for all your policy, so for individual policy, you may be within that criteria of the percentage, doesn't matter. But when I start doing the aggregate of all the premium that you would have paid, then I realize that your total premium during the year is going more than 2.5 lakhs. then in that particular case, students, the exemption under section 1010D will not be applicable. The exemption. No, Bala, it doesn't apply there. It doesn't apply in that range concept. Tolerable. That is only for the arithmetic mean. So in that particular case, students, whenever if your aggregate premium exceed by more than rupees 2.5 lakhs, then the capital gains, students, will that be coming into play? And the answer is yes. Meaning thereby you will not be getting any exemption under 1010D. You will not be getting any exemption under 1010D. On the backdrop of this particular discussion, we will see this particular case study. And the case study, students, in this case, if you see over here, these are the old lot. These are the old lot, students. These are the old lot. Sorry. A, B, and D. For A, B, and D, we just need to ensure whether they are within the 10% threshold of the sum assured. So if you see over here, students, this is what has to be compared. So is it within that 10%? Answer is yes. 50,000 is the annual premium. Sum assured is 6 lakhs, so it is within that 10%. In this case, the answer is no. 40,000 and 35,000 students. The answer is no over here. In this case, ULIP 1 lakh and 10 lakhs. Yes. This is actually taken new. By the way, I must say this is a new one. This that you have taken is a new one. Okay, for which the amendment will be applicable. The old one, the last old one, 1st of Jan 2021, annual premium is 3, and this is there. So this 10% criteria. This 10% criteria is what I'm testing right now. Next is, students, your ULIP of this 10% criteria is fulfilled, yes, and the last 10% criteria is fulfilled. So in all the other remaining cases, 10% criteria is fulfilled, but only in one case, and that too of the old policy, the 10% is not getting fulfilled, which therefore implies that, students, you will have to end up paying tax on B at the time of maturity. When the maturity will take place, when you receive the LIC amount, at that particular point of time on the maturity, the tax will be required to be paid, and the TDS will get deducted under 194 DA. The TDS, students, will get deducted under section 194 DA. So this is what it would be in this context. Now, on this note, students, I'll just quickly run through this important question on the amendment basis. Which are the life insurance policies excluding the ULIP? Now, first, they are excluding the ULIP part, unit link insurance premium. So ULIP are getting excluded. So it implies that they are only talking about A and B. So the question that has been set for all of you right now in the initial MCQ is that exclude the ULIP and then answer. So what is to be considered for this set of MCQs? What is to be considered is only A and B. So what are the life insurance policy excluding the ULIP in respect of which Mr. Manoj would be eligible for exemption under section 1010D in respect of maturity proceed? So definitely, students, only A is what he is going to get the exemption under 1010D. Under 1010D, students. And so far as the second B is concerned, he will not be getting the exemption. So the answer, if you have to see, it has to be between either C and D, because only A is what is eligible for exemption. D will not be eligible for, A is only what is eligible for exemption. B is not eligible for exemption because the annual premium exceed 10% of the sum assured. The annual premium exceeds, students, 10% of the sum assured, isn't it? And therefore, students, in this context, which would be available under 80C in respect of premium paid on such policies for AY 22-23, assume that Mr. Manoj does not have any ULIP only for the purpose of answering this MCQ. Assume that Mr. Manoj does not have any ULIP only for the purpose of answering this MCQ. So, students, as you all are aware, which would be available. So first of all, exemption would be for A. And how much is the ATC deduction, students? Exemption is for A. How much is the ATC deduction? Either 50 or 85. So I told you the ATC deduction is restricted only to that threshold percentage. And the threshold percentage is 10%. So 10% primary primary is what will be considered. So in this case, if you see, so is it within the 10% limit? So 10% of 6 lakhs is how much? 60,000. But how much you have paid actually? 50. So only 50 would be considered. 10% of 6 lakhs is 60, but how much you have paid as a premium? 50,000. So 50,000 would be considered. In the second case, if you see, in the second case, 10% of 3,50,000 happens to be 35,000. How much you have paid, students? 40. So maximum, how much would be the deduction to be considered? 35. So the total deduction, assuming that there is no ULIP, because this MCQ tells you that there is no ULIP. Assuming that there is no ULIP, students, the total deduction is 85,000. The total deduction, students, is 85,000. And that exactly is the point. 85,000 students. So I hope that all of you are clear this one. Coming to the second particular point. Which are the ULIPs? Now they are focusing on the ULIPs part, in respect of which Mr. Manoj would be eligible for exemption under 1010D. In respect of the maturity proceed, choose the option most beneficial to Mr. Manoj. This is important. Which is the option which is there for us, which is most beneficial to Mr. Manoj, students? That is what we need to find out in this context. Now, coming back to this particular part, students, one thing is there. B, any option that you will choose, exemption for D is always available for ULIP because it is in that 10%. We will not see the second condition for D. Only 10% is what is to be taken into account. The second condition of 2.5 lakhs of the aggregate premium will not affect this particular category. Isn't it? All of you agree to this one? So D is safe. In whatever option we'll choose, in that option, please add D also. Because D is a safe case. D does not have the 2.5 lakhs criteria to be considered. So therefore, whatever option that you will finally select in the ULIP, please do add in that option D. Please do add in that option D. So it leaves us now to evaluate which option that we will have to see so that the exemption is there for 1010D. Okay. So 1010D exemption is only for the 2.5 lakhs, up to the 2.5 lakhs. So the other particular LIC premium that you pay beyond that 2.5 lakhs, which goes beyond thereafter 2.5 lakhs, that LIC policy will, which is the ULIP based, that LIC policy will be under a severe scrutiny. That LIC policy will come under severe scrutiny. So I have got, students, if you see over here, I have got 1 lakh from this annual premium and then 1,40,000. So if I take the total of the two, it is 2.4. It is 2.4. So I can take either C and E or I can take only F. I can take either C and E or I can take only F. By taking C and E, primarily it goes to 2.4 lakhs within that threshold of 2.5 lakhs. By taking F only, 2.5 lakhs, so that F will get secured. Primarily remaining will be taxable because their premium, if added, will go beyond 2.5 lakhs, so that those will become taxable. So I need to see what is a better option. And how do we determine that? Better is, students, to calculate the capital gains. To calculate the capital gains. And how do I calculate the capital gains, students, in this context? So students, to calculation of the capital gains, you have to see the maturity amount. So here is a maturity amount of 10 lakhs. 10 lakhs of the maturity amount. And then how many premium you have paid? 9 years, starting from 1st February 2021. 1st February 2021. And then ending on 31st of Jan 2030. So total 9 years premium you would have paid, starting with 1st February 2021. This is the first year. So first premium is 1st February 2021. Like that, if you calculate, second premium is 1st February 2022. Third premium is 1st February 2023. Like that, you have to calculate, and you will calculate to 9 years. So 9 lakhs total premium. So how much is the capital gains? 1 lakhs. From this, let's look upon to this one, ULIP E. For E, it is 15 lakhs of the maturity amount. Sorry, not maturity amount is 17 lakhs. For E, the maturity amount is 17 lakhs. Now, how many years premium he has paid? Again, the same thing. Date of maturity is given to you, and this has been given to you. So 9 years. And if you have to take 9 years at the rate of 1.4 lakhs per year, students, 1.4 lakhs per year into 9 years, it comes to 12.6. 1.4 every year into 9 years come to 12.6. So 17 minus 12.6, students. 17 minus 12.6, this will result into a capital gain of 4.4 lakhs. So now if I take the combination of C and E, my total capital gains would be how much? 5.4 lakhs. This would be total capital gains. Let's see if I take the combination of only F, because F cannot be combined with any other thing because its premium itself is 2.5 lakhs. F cannot be combined with any other particular aspect because its premium itself is 2.5 lakhs. So therefore, in that context, if I will see over here in this context, so what is that I'm going to get it? Amount that I receive on maturity is 28 lakhs. Amount that I received on maturity, students, is 28 lakhs. And thereafter, if you see in this context, thereafter, again 9 years from 1st of February 2021 to 31st March 2020, 30. First premium is 1st April 2021. Second premium is 1st April 2022. Third premium is 1st April 2023. Like that, you have to calculate the premium. So 9 years. So 2.5 lakhs into 9 years, students, that comes to 22.5 lakhs. 22.5 lakhs, and that 22.5 lakhs, this will result into 5.5 lakhs. So in this case, my capital gain is 5.5, students, in this context. Capital gain is 5.5. Students, just a second. Here it is 11 lakhs. Maturity amount is 11 lakhs. And therefore, the capital gain is how much? 2 lakhs. The capital gain is 2 lakhs. So tell me one thing. If I take only F as the option to be saved for exemption, then my saving of the capital gain is 5.5 lakhs. But if I take the combination of C and E, then my total capital gain saving, total capital gain would be 6.4. 6.4, students. You tell me now which is the better of the two. Obviously, I should save on this combination of C and E. I should save on C and E because, yes, Akash, I should save on, students, C and E. I should opt for exemption for C and E because that will result into the exemption of 6.4 lakhs of the capital gains. That will result into the exemption of 6.4 lakhs as against only F. That will result into the exemption of 5.5 lakhs. So my option has to be, students, C and E. And I told you already, whichever option you choose, please add in that option D also, because D is not regulated with the additional limit of 2.5 lakhs. D only goes with the 10% thing. So final answer would be C, D, and E. Final answer, students, would be C, D, and E. So this would be my final answer, students. Now, considering the option chosen in MCQ number 2 above, what would be the capital gains computed under section 45(1)(b)? So obviously, I've already calculated the capital gains, which will be taxable. So how much will be taxable, students? The taxable calculation would be from F. The taxable calculation of the capital gains would be from F, isn't it? So F in this case would be the taxable portion of the ULIP, and the capital gains that would be taxable would be 5.5 lakhs. Is that clear to all of you, students? All of you are clear with this one? Now, what would be the TDS under 194 ADA, students? That has to be deducted. The TDS, students, that has to be deducted on the payment of maturity proceed of life insurance policy to Mr. Manoj in this context. Now, how to decide in this scenario, students? In this context. So please be careful. Proceed on the life insurance policies. Total tax which is deductible in respect of the life insurance policy, students. Now, here in this case, if you all will see, so as far as Mr. Manoj was concerned, students, the TDS which has been there in this regard, so that is excluding the ULIP. 194 DA is excluding the ULIP, students. Excluding the ULIP. So TDS calculation of 194 DA, students, are you aware of that? How to calculate a TDS calculation? So maturity amount is 4 lakhs. Again, the problem. Maturity amount, students, is 4 lakhs. You will calculate, students. Maturity amount is 4 lakhs. This amount of 4 lakhs. From, I'm talking about B. I'm talking about B, students. So maturity amount is 4 lakhs. 4 lakh minus the total premium paid so far. The total premium paid so far. So for how many years the premium has been paid? So first premium was 1st April 2015, 1st April 2016, 17, 18, 19, 20. That's it. 20 and 21. 1st April 2021 is the 7th year. And my 8th year would be 1st April 2023. My 8th year would be 1st April 2023. But when is the maturity? 31st March 2022. So it is only of the 7-year premium that has been paid. So 40,000 into 7 comes to 2.8 lakhs. So whatever is the amount out of the premium that you have paid, so 4 lakhs minus 2.8 lakhs, 4 lakhs minus 2.8 lakhs, that comes to students 1.2 lakhs of the amount. So that is the income component. Students, that is the income component in that particular maturity amount. And on that income component of 1.2 lakhs, 5% is the TDS rate, 5% is the TDS rate, and that gives you 6,000 rupees. That gives you, students, 6,000 rupees, and that covers up your capital gains, all the amendments, students, which are being there in the form of a case study. One question definitely has to be there from this in your examination. One question definitely, students, has to be from this in your examination. Is that clear to all of you, students? Now, students, one last session, as I told you, wherein we will do this TDS assessments and all, the questions and the comprehensive questions towards the end. So that would be my last session. I will be keeping you updated about that. But as I don't know what would be the scenario, but I will ensure that this updates, students, you can also join my Telegram channel, CA Durgesh Singh. There I'll put the updates of the link of this last English particular class which has been there. Fine, students. So keep revising, students, in this case. And then we'll meet up for our last session in this context. Fine, students. Okay, students. So good night to all of you, students. Meantime, study hard, and we will have to then cover up the remaining part. Yeah, Nitish.
Yeah, that was a very great session, sir. I thank you on behalf of the students and participants who are getting benefit from this video.
Thank you, Nish. Thank you for the opportunity. Thank you, SIRC. Thank you.